Hey everybody, welcome. This is Unit 4, the financial sector. That's the name of Unit 4. We're in the first sub-unit, okay, which is 4.1, financial assets, and this is Part 1. So in here in Part 1, we're focused on financial assets. What are the financial assets we're focused on? Stocks, bonds, savings accounts, and M1. What we're going to be talking about is these financial assets in relation to these three categories: liquidity, risk, and rate of return. Now, before I get going any further, I want you to understand that at the center of Unit 4 is this thing called monetary policy, okay? What is monetary policy? It is when the central bank of an economy, in the United States, our central bank is the Federal Reserve. It's when the central bank of the economy changes the money supply in the economy. They do this in hopes of stabilizing the economy, okay? So remember, our economy grows in busts and booms, okay, in that business cycle. And we use monetary policy as one of our tools to try to stabilize that growth, okay? Again, monetary policy, changing the money supply. Who's doing it? The central bank. And they're doing it to try to stabilize that economy. So, to understand how the Fed does that, we need to understand financial assets, especially these top three. But we're going to talk about all four in this video, okay? Stocks, bonds, savings accounts, and M1. So let me get started right off the bat. I'm going to start with this M1. Why? Because you've heard of stocks, bonds, and savings accounts probably, but this is jargon right here. So let's start with the jargon. What is M1? M1 is what we call money, all right? So money. Well, what the heck is money? Money is a financial asset that in its current form can be used to buy goods and services. Another name for M1 is it is our cash, okay? It is our cash. Now, at first, this is going to seem kind of like no duh, but there is a little bit of trickiness here, okay? The no duh part is, well, of course our cash is money, okay? The trickiness, okay, the little bit of tricky is that what we mainly think is cash is the pieces of paper in our purses and in our wallets. And yes, that is cash, but that is what the economist calls currency, okay? That is currency. There is something else that the economist calls cash, and that is money in your checking account. That's right, the money you have on deposit in a bank in your checking account is also cash to an economist. Now, I'm not going to write the word checking account. You can see I'm writing the word demand deposit, okay, the term demand deposit. So right from the beginning, I want y'all to get this straight. A demand deposit is a checking account. Demand deposit is a term economists use for money in your checking account. Why do they like this term? Because this is money you have on deposit that you can get on demand. Okay, this is part of your wealth that you can get on demand to buy goods and services. It helps give us that understanding that demand deposits is absolutely money. This, in its current form, can be used to buy goods and services. You can write a check, you can use a debit card. Okay, so I hope that makes some sense. Now, technically speaking, there is another part of M1. The final part of M1 is traveler's checks, okay? Traveler's checks are also money, and you can even call them cash, okay? Why are traveler's checks money? Because in their current form, again, you can buy goods and services. That's what makes something money. That if it's in its current form, you can use it to buy goods and services. People accept it as payment for goods and services. It's money. I'm not putting traveler's checks up here. Why? I just don't think it's a big enough category, okay? I like to just say, hey, there's currency and demand deposits. That's 95, 98, 99% of the world. That's good enough, okay? So those are the two big ones. Finally, I want you to understand that your M1 assets, okay, your currency and your demand deposits, they are 100% liquid, okay? What do I mean when I say 100% liquid? They're money. In their current form, they can be used to buy goods and services. Something that is 100% liquid means that in its current form, it can be used to buy goods and services. So in other words, there's a lot of synonyms. Okay, if I say money, I mean cash. If I say cash, I mean 100% liquid. Those three things all go together. Now, let's get going with the rest of these. Okay, I've got stocks, bonds, savings account. Let's start off with stocks. Before I get into it very much, what the heck is a stock? Okay, stocks are often called equities. Equities. So the next question is, what the heck is an equity? An equity means ownership. All right, so if you own stock in a company, if you own some of the stock of a company, you have ownership in it, okay? You have an equity position in it. And since you have ownership, you have a right to its profits. Now, Before I go into these three things, liquidity, risk, and rate of return in regards to stocks, let me stop for just a second, okay? Because I want to make this real for you. You might already be investing some, or your parents might be investing, okay? And they might say, you know what, I own index funds, or I own mutual funds. I want you to understand when you hear your parents say that, or if you do it yourself, own index funds or mutual funds, that what they're really saying is they own an instrument that owns a bunch of stocks, of different stocks, okay? Or they own this instrument that owns a bunch of different bonds. And some mutual funds might own a mix of both, okay? So when you think about later on in your life, when you start investing, a lot of your investment, there are a few financial assets I don't have up here. I don't have any real estate up here right now. But a lot of your investing will be in stocks and bonds. Even if you don't buy stocks and bonds directly, you'll buy these things called mutual funds or index funds, which is just a way to buy a lot of different company stocks or bonds by buying a single thing, an index fund or a mutual fund. All right, just want to put that out there for you a second. Now, let's get back to what I said. Let's go with liquidity, risk, and rate of return. Stocks. Pretty doggone liquid. What do I mean by liquidity to begin with? What do I mean pretty doggone liquid? What I mean is, in a fairly short period of time, without having to really take a hit on the market value of it, you can change it into money, okay? When we say something's very liquid or highly liquid, okay, that means in a short period of time, without having to take any type of penalty, without having to see the value of that thing getting cut very much, you can pretty quickly change it into money. Now I'm talking broad strokes here, okay? This isn't true for all stocks, but many stocks are traded in such volume every single day that if you ever want to liquidate them, i.e. turn them into money, sell them to turn them into money, you can do it pretty doggone fast and you should be able to get the market value. So pretty liquid. Risk. Now here's where there's a lot of nuance that I'm going to ignore, all right? There is a lot of nuance I'm going to ignore for the most part. Risk. Stocks, we're going to say, is the highest risk out of all of these. Now, technically speaking, there are bonds that are higher risk than some stocks. But I'm saying, on average, stocks are more risky than bonds, okay? Just on average. And not all stocks have the same risk. Twitter, okay, that's, you can buy stock in Twitter. And then Coca-Cola, you can buy stock in Coca-Cola, all right? They're not the same risk. Those two stocks aren't the same risk, okay? You can also buy stocks in a utility company. Definitely not the same risk as Twitter, all right? So different companies, the stock of different companies have different risks, but in general, broad strokes here, we're going to say stocks are the highest risk. They also, again, broad strokes here, can provide the highest rate of return. Why? Because they have just got an infinite upside, okay? You get ownership in a company and it starts growing, it starts getting bigger and bigger and bigger and bigger and bigger. You hold that ownership position, guess what? You can be making a lot of money, all right? You buy a young company, IBM when it was really young, or like more modern times, you bought Amazon, say 20 years ago, okay? There's a humongous rate of return that you can get, okay? Pretty much an infinite upside. Now, big takeaway right from the beginning here, right now, is that look at that relationship. In general, okay, higher risk, higher rate of return, okay? If you're willing to take on more risk, you have a chance of making a higher rate of return. But remember, understand that relationship. You take on more risk, there's also a chance there you might get no rate of return or a negative return, right? So risk, and you know, there's two sides to it. Yes, it can get you a bigger rate of return, but it also means that you can lose a lot of money. Bonds. Bonds are a debt instrument or a debt contract. Okay, that's the big thing. If you own a bond that a company issued, you don't have any ownership in it, okay? However, you own a debt contract. You own a piece of paper that says, hey company, you owe me money. You owe me the principal and you owe me interest payments as long as this bond has not matured, okay? So, bonds are debt instruments. They are not ownership. Liquid. Again, highly liquid. What does that mean? They're traded in a lot of volume, in pretty high volumes, and you can pretty easily turn it into cash pretty quickly, okay? For most bonds, not all, but most bonds, big companies or government bonds, you can sell those quite fast and turn it into cash. Risk, in general, a little lower risk than stocks. Now, of course, there are some bonds issued by some companies. Let's say it's a company that might go bankrupt. Well, that's a much higher risk. And of course, they're going to have to pay higher interest, okay? A company that might go bankrupt has a higher chance of going bankrupt than another company. Hey, they know that their bonds are more risky. Whoever buys them are just taking on more risk, and so they're going to have to pay higher interest, all right? So people who buy those bonds can get a higher rate of return, but again, there's more risk. But in general, bonds in general, on average, are less risky than stocks. Let me put it this way, okay? You start investing in your mid-20s for your retirement. Just talking about your retirement investing, okay? So, you're investing for your retirement. You're not going to need that money for 30, maybe 40 years. What financial planners will say is, hey, you should own almost all stocks, okay? They're going to put you really heavy into stocks, 90, maybe even 100% into stocks. Now, as time passes, as you get to your retirement age, guess what? You're going to rebalance that portfolio, and you're going to move it or reallocate that portfolio, and you're going to move more of that portfolio into bonds. Bonds will become take on a higher percent of your portfolio. Why? Because on average, they are less risky, but again, provide a lower rate of return. All right, so we took care of all that for bonds. Finally, savings account. Let's talk about liquidity. Highly liquid, okay? Highly liquid. In fact, so liquid, I'm going to put that up here, okay? They are highly liquid. In fact, so liquid, we are going to call them near monies. Near monies, okay? They're almost money. They are nearly money. You can move money from your savings account to your cash super fast and almost always with very little hit to the value of it, okay? Maybe zero hit at all, okay? Move from here to here and not lose any of the value at all and do it super quick. In fact, they are so liquid that there is what's called a monetary aggregate in macroeconomics called M2. As you notice, M1 is a monetary aggregate. I didn't say that before, but just real quickly, getting really into the jargon. M1 is a monetary aggregate. What do you mean it's a monetary aggregate? It aggregates currency, demand deposits, and remember those traveler's checks, right? M2, it includes M1, but it also includes savings accounts. Now, in general, don't care a whole lot about that M2, okay? Used to look at it a lot more in macroeconomics. We don't pay that close attention, but we're still supposed to know what it is. It includes money and these near monies. Risk, incredibly low risk. Savings accounts, incredibly low risk. In fact, they are FDIC insured for the most part. Most of them are FDIC insured, which means if the bank goes bankrupt, you'll still get your money. The federal government will give you your money. Rate of return, very low, right? Risk, very low. Rate of return, low. We're shooting this in April of 2020. Right now, interest rates for money in your savings account are paying anywhere between 0.05 and 1.8 at the very high end, okay? Most banks are paying somewhere in between that. And that's it. That's all you're going to earn. So rate of return, quite low. Okay, final things as we finish this one up. There is this red line, the red line between the M1 and all of these, okay? Why am I doing that? Because I want to say there's an advantage and disadvantage. There's a major advantage, a major disadvantage to this, and there's a major advantage and disadvantage to the ones below the red line. For the M1, what's the major advantage? The major advantage is that in its current form, it can be used to buy goods and services. Major disadvantage of M1, it provides almost no return. Technically, some checking accounts can provide a very small interest rate, but for the most part, guys, they provide just about nothing, okay? So, currency, no return, traveler's checks, no return, demand deposits, incredibly low, and oftentimes no return at all. Conceptually speaking, I basically want you to think M1, no return. So downside of this, no return. Upside of this, in its current form, it can be used to buy goods and services. What's the downside of these things right here? Well, they can't be used to buy goods and services. They're not money. What's the upside of these things? Well, the upside is they provide a return, okay? So you can see the symmetry between those. So that's the big thing. What are we going to be talking a whole lot about? We're going to be talking about holding some of your financial wealth as M1 and holding some of your financial wealth as these things. We'll oftentimes be talking about, moving, some of your financial wealth from here to here, or moving some of your financial wealth from here to here. We'll be talking about the cost of holding some of your financial wealth as M1. Let me go ahead and tell you right now, right from the get-go, what is the big cost? It's the nominal interest rate. Why? Because, once again, you don't get paid interest when you hold M1, all right? And so what are you foregoing? What is the opportunity cost? What is the opportunity loss of holding M1? It's the nominal interest rate, because you could have earned some interest here, okay? So those are the types of things that we're going to be talking about as we get going in this unit. Anyhow, that's a broad overview of financial assets. I hope it made sense to you. We'll see you in the next video.